Hi, this is Mike Looby from Directors Financial Group. I'm here today to directly answer the most frequently asked questions on the new HARP 2.0 program. What is HARP 2.0? HARP stands for Home Affordable Refinance Program, and it is a special program designed for people who have a Fannie Mae or Freddie Mac owned loan and which allows people to refinance their mortgage using loosened underwriting guidelines. This would be for people who might have trouble qualifying in today's tough underwriting environment and or for those who have negative equity in their home due to the declining property markets. We call this being upside down or underwater on their mortgage. Who is going to be able to get this loan? Basically, it is going to be anyone who obtained a mortgage prior to June the 1st, 2009. If you closed after that date, unfortunately, you won't be eligible. What about other hardships other than negative equity? Are there any other requirements? Do you have to do a hardship letter or anything like that? No. In fact, hardship actually really doesn't apply so much to the refinance portion of it, except in terms of negative equity. A major factor is that we still have to show that they're capable of paying their bills. In fact, the program requires that homeowners are current on their mortgage and that they have had no late payments in the past 6 months and only one late payment in the 6 months prior to that. The other thing it allows for, aside from looking at any negative equity situations, is it's also looking at anybody who might have higher debt-to-income ratios. This will help people who may be self-employed and got a stated income loan many years ago. Underwriting may allow for higher debt-to-income ratios on the HARP program than it will on a standard conventional loan right now. And what about the borrower? Are there going to be any income requirements, or will they have to have their employment verified? Here are the guidelines from eFannieMae.com. The lender must obtain a verbal verification of employment, or VOE, and verify the borrower's source of non-employment income, plus obtain any other income documentation as required by their findings report. However, if the borrower's principal and interest payment is increasing more than 20%, the borrower must be requalified for the new loan, including verification of all income sources and amounts, and verification of any assets needed to close, in accordance with standard underwriting requirements. It also depends on which lender you are dealing with. They may have their own guidelines. Why would someone be able to go up on their payment more than 20%? Well, someone may have an interest-only loan or an adjustable rate loan that is artificially low right now and getting ready to adjust upwards. Or someone may find it worth going from a 30-year loan to, say, a 15 or 20-year loan. It all depends on the situation. Are there going to be debt-to-income requirements? First, let's talk about what debt-to-income is. Some lenders may add their own guidelines as far as debt-to-incomes are concerned. We call these overlays. Fannie Mae has not posted anything as a hard, fast rule except for when the payment is increasing by that 20% we talked about. The rule of thumb is they need to be at or under 45% debt-to-income if they're going to be increasing their payments by 20%. If somebody's in a 30-year mortgage and they want to take advantage of these great 15-year rates we have, if their payment does increase beyond that 20% threshold, they do have to adhere to a 45% debt-to-income. What are the credit score requirements? If the payment increases by 20%, per Fannie Mae guidelines, they are looking for a 620 FICO score. If not, if you're just someone who's in a 30-year right now and are reducing your payment, per Fannie, there's no credit score requirements. However, we are right back to that lender overlay again. Individual lenders may have their own guidelines added on to Fannie's. For example, the individual lender may require that they are the current servicer of the borrower's mortgage, meaning the borrower currently already makes their payment to said lender in order for them to have no minimum credit score requirements for that refinance. How about the verification of assets or reserves? Do you have to show you have money? It depends. For the most part, though, the answer is no, unless that payment is going to increase by more than 20%. When we input your info into the automated underwriting system, it will tell us if you need to have any funds verified. And what if there were two people on a loan and you wanted to take one off? Let's use divorce as an example. First, it's not always easy, but it is possible. You have to show evidence that the remaining borrower has made the mortgage payments from their own funds for the last 12 months. What about the other way around? What if you want to add someone? Well, you can, but I wouldn't do this unless you really need to. They do need to qualify under the same guidelines that the original borrower qualified under as well. Is there a max LTV or loan to value? In other words, is there a maximum percentage that they can be at if the loan balance is greater than the value of the home? Well, for the most part, there's not going to be a max LTV if you're doing a conventional mortgage like a 30-year, a 15-year, or a 20-year fixed-rate mortgage. It used to be 125%, but that changed, so basically the answer is no. However, there are going to be caps for unique products like adjustable rate mortgages or the 40-year fixed mortgage. Just call me and I'll see what these caps are, and I'll let you know if it's right for you. Will there be an appraisal? And how will the value be determined? Each loan requires field work, and an appraisal is part of that field work. The following transactions can get a waiver of the field work if they are one-unit properties, primary residences, second homes, and investment properties. Currently, the fieldwork waiver will not be offered on cooperative units, manufactured homes, 2 to 4 unit properties, and loan case files that receive an ineligible recommendation. So the long and short of it is, most of the time there will not be an appraisal required, but depending on your file, it could be. As far as determining value, most of the time it will be done through the automated system. What about a second mortgage? How does that fall into place here? Say if the house is worth $150,000 and they owe $150,000 on the first mortgage and $100,000 on the second. How does that work with the second? The second mortgage holder is going to have to agree to be second in line to the first. This is called subordination. Basically, the second mortgage holder has to allow your new lender from your refinance to leapfrog ahead of them on the title to gain first lien position. If they don't agree, the loan can't be done. And can a home equity line of credit or a construction loan be rolled into one loan? No, you're not going to be able to do that on this product. This product is strictly to do with the first mortgage. If there is a second, that lender must subordinate. And can the occupancy type change? What if it was bought as a primary residence and it is now a second home or an investment property? There's going to be no restrictions on the occupancy type. Primary residence, second homes, and investment homes are all eligible as long as they are one-unit properties. And what if the property is for sale? How does that work? You used to have to take the house off the market, but it looks like Fannie Mae is waiving that requirement. I don't know whether lenders will have any overlays on that, but according to Fannie Mae, they're going to let you do that. Is there any seasoning requirement if somebody has gone through a bankruptcy or foreclosure? If you are smack dab in the middle of a bankruptcy or foreclosure, it isn't going to work for you. However, once you are finished, there won't be any requirements. So even if you can't do the loan right now, there may be time to do it later. Just give me a call and we will let you know. What about jumbo loans? Is this going to work for jumbo loans? No. By definition, a jumbo loan is not backed by Fannie or Freddie, so it doesn't even pass the first litmus test. If you are in an area where you've got jumbo conforming mortgages or high balance loans, you may qualify. If you aren't sure whether you have a regular or conforming jumbo, just give me a call and I'll let you know. And how long is the program available? There is a scheduled end to the update, and that's going to be at the end of 2013. For any but one who wants to take advantage of this, obviously the greatest and best time is now, because we don't know where interest rates are going to be next month, much less the middle of 2013. The reason that we want to make sure that you're moving quickly is to make sure that those who can qualify and are eligible have the ability to do it today. And how long are these taken to close? Is it kind of typical, or any shorter or longer? What are you seeing? Right now you're looking at typical time frames. I think as more people find out about the program, there's the possibility of increased volume, so you could be looking at 45 to 60 day close times in some cases. That's not going to be the case with everyone, but I think if you carry those longer expectations and close earlier, then you won't get frustrated. The bottom line is patience is a virtue, and here I think it would be a very good virtue. You are looking at getting a loan whereby you never thought it was possible before. What if someone isn't Fannie or Freddie? Are they out of luck? If they have an FHA mortgage, they may be able to do an FHA streamline refinance. There are other programs that may become available too. Also, keep in mind that although someone may not be eligible right this minute, because HARP is good through December 2013, they may be able to become eligible at a later date, but in time to meet that deadline. So really, the best thing they could do is call to talk and see what can be done to help them. I really appreciate our listeners on this video. I want to emphasize that I'm here to help you. Give me a call here at the office and let's see what I can do to help. Do yourself a favor. Get the savings that you're entitled to, because you deserve it.